Welcome to our deep dive into the art of packing your retirement. Think of your 401k or your retirement plan not just as a savings account, but as a suitcase for your future financial destination. Most people approach their retirement contributions with a chaotic mindset, which is represented by the overstuffed and inefficient suitcase on the left. They throw in whatever fits at the moment without a real strategy, often leaving valuable tax-advantaged wealth on the table because they do not understand the rules of the game. On the right, we see the optimized and tax-advantaged approach where every dollar is placed with precision. This visual comparison illustrates contribution limit optimization. Your retirement plan has a strict weight limit set by the IRS, but how you pack that space determines your financial arrival. Today, we are going to move away from the messy and inefficient method and show you how to utilize every inch of your retirement containers. By the end of this presentation, you will understand that retirement planning is about more than just saving money. It is about maximizing efficiency and ensuring that your future self has everything they need for the journey ahead. Let us move into the core concept of the three containers of wealth. Most savers stop at the first container, which is the standard $23,000 employee deferral limit. They believe that once they hit this number, they have reached the maximum benefit allowed by the government. However, they do not realize that the IRS provides a much larger outer shell that includes employer money and advanced saving strategies. Beyond that $23,000 core, there is an additional $7,500 catch-up provision for those age 50 and older. But even more surprising to many is the total limit, which can reach $69,000 or even $76,500 for older individuals. This creates a massive amount of unused capacity. You likely have approximately $37,000 of unused tax-sheltered space that you did not even know existed. Understanding these concentric circles of wealth is the first step in moving from a basic saver to an optimized investor. Our goal today is to show you how to stop leaving that capacity empty and how to strategically fill these outer containers to accelerate your path to financial independence and long-term security. When we look at container number 1, which is the employee deferral, think of it like a bucket being filled by two different taps. One tap provides pre-tax or traditional contributions, while the other provides post-tax or Roth contributions. The $23,000 limit applies to all your deferrals combined. This is a crucial point because you can mix the contents to fit your specific tax strategy, whether you want to defer taxes now or secure tax-free income later. But you must remember that the total volume allowed in this bucket is absolute. This leads us to the trap, which is that you cannot double dip. Many people mistakenly believe they can contribute $23,000 to a Roth 401k and another $23,000 to a traditional 401k. This is strictly prohibited. If you try to do this, you will face tax penalties and a lot of paperwork to correct the over-contribution. The key here is flexibility within the constraint. You have the power to choose which tap to turn on and how much of each to use, but the bucket only holds $23,000 in total. Navigating this first container correctly sets the foundation for all the more advanced strategies we will discuss later. For those of you approaching a significant milestone, turning 50 is not just another birthday. In the eyes of the IRS, it is a clearance level upgrade. This brings us to container number 2, which is the age 50 advantage. The catch-up provision unlocks an extra $7,500 in saving capacity. If we think of your retirement plan as a mechanical engine, the standard $23,000 limit is your base engine. However, when you reach age 50, you are allowed to add what we call a catch-up module. This is like adding a turbocharger to your retirement vehicle. This increases your new capacity to a total of $30,500. The years between age 50 and 67 are your super saver years. This is the period where many people are at their peak earning potential, and their expenses might be stabilizing as children move out or mortgages get paid down. It is the perfect time to use this extra capacity to sprint toward the finish line. Do not view the catch-up as an optional extra, but rather as a critical component of your late-stage financial engineering. This extra room allows you to make up for lost time or to simply build a much larger cushion for your golden years. Now we must discuss a common mistake that even the most diligent savers make. This is the trap of front-loading versus the employer match. Many high earners want to be aggressive and max out their contributions as early as possible in the year, like by March or April. However, if your company plan lacks a specific rule called a true-up provision, you could be losing thousands of dollars in free money. Look at the chart on the screen. If you max out your $23,000 by March, you only get the employer match for those 3 months. For the rest of the year from April to December, you are not contributing, and therefore the employer is not matching. In this scenario, the potential match might be $5,000, but because you stopped contributing, you only received $1,600. This results in a loss of over $3,000. Your action item is to check your plan documents for a true-up provision. If your plan does not have this, you must spread your contributions evenly across all 12 months to ensure you capture every single dollar of the employer match. This is a perfect example of how being too fast can actually cost you wealth in the long run. In the world of investing, consistency beats intensity every single time. Let us compare two different types of investors. The first is the perfectionist who tries to max out $23,000, but can only do it sporadically for 10 years before stopping or becoming inconsistent. They end up with a small snowball worth about $579,000. On the other hand, we have the incrementalist. This person contributes a steady $12,000 consistently for 30 years. Because they allowed the power of time and compound interest to work for 3 decades, they end up with a massive snowball worth over $1.2 million. The lesson here is clear. Do not wait for the perfect year or the perfect salary to start being serious about your retirement. Consistency, combined with compound interest, creates exponential wealth. The perfectionist is often waiting for the right moment, while the incrementalist is already halfway down the hill. Start with what you can afford and keep it going through the ups and downs of the market. Long-term discipline is the secret ingredient that turns modest savings into a substantial fortune. The incremental approach is much less stressful and far more effective over a full career span. Choosing between a Roth and a traditional account is often framed as a difficult decision, but the best strategy is building a bridge to retirement. The Roth account locks in your tax rate today because you pay the taxes up front. This provides certainty. The traditional account is a bet on a lower tax rate tomorrow because you get a tax break now, but will pay taxes when you withdraw the money later. This involves uncertainty because nobody knows what the tax code will look like in 20 or 30 years. Since the future is unknown, the safest and most professional play is tax diversification. A great rule of thumb is to aim for a mix, such as 70% traditional and 30% Roth. This gives you flexibility on both sides of the bridge. When you are in retirement, you can pull money from whichever bucket makes the most sense for your current tax situation. If tax rates are high, you pull from the Roth. If you have a year with many deductions, you pull from the traditional. By having both, you are protected against future legislative changes, and you give yourself multiple options for managing your cash flow in the future. Diversification is not just for your investments, it is for your tax strategy as well. Let us explore the most overlooked area of retirement planning, which we call container number 3, or the void. Most people think the game ends at $23,000, but the IRS actually allows a total contribution of up to $69,000 across all sources. This void represents about $36,000 of unused capacity that sits between your employee deferral and the total limit. It is the most valuable real estate in your financial portfolio because it allows for massive amounts of wealth to grow in a tax-advantaged environment. How do we fill this void? The secret weapon is after-tax contributions. These are different from Roth or traditional deferrals. After-tax contributions go into your plan after you have already paid income tax on them, just like a normal brokerage account. However, the advantage is that within the 401k environment, these dollars can be treated much more favorably than in a taxable account. If you are a high earner who has already maxed out your base, $23,000, and you are still looking for ways to save this empty space, is where the real magic happens. Understanding the blueprint of your plan is the only way to identify if you have access to this powerful tool. For those seeking elite optimization, we have the Mega Backdoor Roth. This strategy allows high earners to fill the void we just discussed with after-tax dollars and then immediately convert them into a Roth account. This process bypasses the standard income limits that usually prevent high earners from contributing to a Roth IRA. By moving money through this specific plumbing system, you can achieve massive tax-free compounding on tens of thousands of dollars every year. There are 3 specific requirements for this to work. First, your employer plan must allow for after-tax contributions. Second, the plan must allow for in-service conversions, which is the valve that lets you move money from the after-tax bucket to the Roth bucket. Finally, you need strong cash flow to take advantage of it, because you are using money that has already been taxed. If these 3 things align, you are looking at one of the most powerful wealth-building tools in the entire tax code. It effectively allows you to shovel huge amounts of money into a tax-free growth environment that will never be taxed again. This is the pinnacle of retirement plan optimization and can add hundreds of thousands of dollars to your final nest egg. The biggest enemy of financial success is not a lack of knowledge, but rather analysis paralysis. This is the psychology of good enough. On the screen, you see a traveler standing at a signpost with dozens of options like traditional versus Roth, or ETFs versus index funds, or crypto versus real estate. Many people get so overwhelmed by these choices that they never start. They wait for the perfect strategy, and in doing so, they lose the most valuable asset they have, which is time. A good strategy implemented today beats a perfect strategy implemented next year. Look at the turtle on the path. He is moving slowly, but he is moving. The traveler is still looking at the map, while the turtle is making progress toward the destination. Your goal should be to automate a good enough strategy today. You can always optimize for a perfect strategy tomorrow as you learn more. Set your contributions to a level you can handle and choose a broad index fund. That simple action puts you ahead of the majority of people who are still standing at the signpost. Automation removes the need for constant decision-making and ensures that your retirement continues to grow even when you are not thinking about it. To make these concepts concrete, let us look at some real-world optimization scenarios. Sarah is 28 years old and she is a match hunter. Her main goal is capturing free money, and her mix is 70% Roth because she expects to be in a higher tax bracket later in life. Marcus is 45 and he is the balancer. He maxes out his $23,000, but uses a mix of 40% Roth and 60% traditional to manage his current tax bill while still building tax-free wealth. Finally, we have Jennifer, who is 54, and she is a maximizer. She is using the catch-up provision and the mega Backdoor Roth to hit the full $76,500 total limit. She is in her peak earning years and wants to shield as much as possible from taxes. These 3 people show that your strategy must evolve over time. What worked for you at age 25 will likely not be the best approach when you are 55. As your income increases and your retirement date approaches, you must shift from simply gathering assets to strategically placing them in the right containers. Reviewing these profiles should help you identify which stage you are in and what your next move should be. One of the most important aspects of future-proofing your retirement is understanding that the containers are growing buckets. The IRS increases contribution limits to keep up with inflation. For example, back in 2001, the limit was only $10,500. By 2012, it rose to $17,000, and in 2024, it has reached $23,000. If you set your contribution as a fixed dollar amount, you are effectively falling behind every single year because your contribution stays the same while the limit grows. The solution is simple but powerful. You must set your contributions as a percentage of your salary rather than a dollar amount. When you do this, your savings automatically capture limit increases as your salary grows or as the IRS updates the rules. It ensures that you are always utilizing the same relative portion of your income for your future. This one small change in how you set up your payroll deductions can have a massive impact over a 20 or 30-year career. It turns the growing bucket from a challenge into an automated advantage that works in your favor without you having to manually update your settings every time the laws change. Now that we have covered the theory and the strategies, let us look at your implementation checklist. It is time to turn this knowledge into action. For the immediate term, your first priority is to ensure you are capturing the full employer match. This is a 100% return on your money and should never be ignored. In the short term, you need to audit your plan for a true-up provision to see if you can be aggressive with your timing or if you need to spread contributions out. For the medium term, you should set up an automated 1% annual increase. This is a painless way to ramp up your savings rate over time. Finally, in the long term, you should perform an annual review of your tax diversification and see if you are ready to move into advanced strategies like the mega Backdoor Roth. The key takeaway is to do step 1 today. Do not leave this video without at least checking your current contribution rate. Schedule a time on your calendar for step 4 during your annual financial review. By breaking these down into time-bound tasks, you make the process of optimization manageable and much more likely to be successful. Some people might wonder if all this optimization is really worth the effort. Let us look at the price of efficiency. The difference between a basic saver and an optimized saver is not measured in pennies. It is measured in hundreds of thousands of dollars. On this graph, you can see two paths over a 30-year period. Path A represents the basic saver who puts in a decent amount but does not optimize for matches or tax efficiency. Path B represents the optimized saver who uses the strategies we have discussed today. After 30 years, the difference is over $600,000. This is what we call the optimization dividend. This gap represents retirement freedom. It is the difference between worrying about bills in your 70s and having the wealth to travel or support your family. When you spend an hour researching your 401k or talking to a professional, you are essentially earning a massive hourly wage because that 1 hour of optimization can lead to $500,000 of extra wealth in the future. Optimization is the highest hourly wage you will ever earn. It is the bridge between a comfortable retirement and a truly wealthy one. The math is undeniable, and the results are life-changing. We have reached the end of our journey today. You now understand the containers, and you have the map to navigate them. Remember that the limits set by the IRS are tools for you to use rather than constraints to hold you back. You have seen how consistency beats intensity and how the mega Backdoor Roth can supercharge your savings. You have the checklist and the real-world scenarios to guide your path. Now it is time to start packing. Your future self will thank you for the work you do today to organize your financial suitcase. Whether you are a match hunter like Sarah or a maximizer like Jennifer, the principles of optimization remain the same. Take control of your retirement destiny and ensure that your arrival at financial freedom is as smooth and successful as possible. Please share your feedback in the comments. We love hearing your ideas for future videos as well. If you find this useful, please share, like, and subscribe. And smash that notification bell to stay updated on our latest content. Thanks for watching and see you in the next video.